Hello, ladies and gentlemen. So as you know, we weren't able to go through this particular section of our slides within our classes this week. So what I thought is I would create a video to take you through the audit risk model. So let's get started. Now the audit risk model, and I'll highlight that over here, is incredibly important because we actually use this model to determine how we're going to approach the audit, and we do that for every single audit client. So what is the audit risk model? Well, the audit risk model is this equation that you see up here. And basically what it is these concepts brought together. So audit risk is a function of inherent risk, control risk, and detection risk. Now I'm going to take you through these elements in just a moment, but let's start with the left-hand side. Audit risk. What is audit risk? Audit risk is the risk that the auditor expresses an inappropriate audit opinion or an inappropriate audit conclusion when the financial report is materially misstated. Now, what does this mean? Essentially, what this is saying is audit risk, guys, is the risk of providing an incorrect audit conclusion, an incorrect audit opinion as to whether the financial report is indeed true and fair or not. So it's almost like saying, and a really good example of what this means is the risk of us providing a happy face report, so us providing an unmodified audit report, which essentially says that we believe the financial report is indeed true and fair, when we should have actually provided a sad face report and a modified audit report because the financial report was indeed not true and fair. Right? So basically, if you want to summarize this, audit risk is essentially the risk of providing an incorrect audit report. It's providing a unmodified, a happy face report when in fact the information is materially misstated. Now, this is why providing an incorrect audit report is actually a really, really terrible thing. And we talked about this in our second lecture, and that is because by providing an incorrect audit opinion or an incorrect audit conclusion, it can expose us to legal liability. That is why we always want audit risk to be as low as possible. We want the risk of providing an incorrect audit opinion to be as low as possible. So how do we achieve that? Well, we try to reduce audit risk as much as we can, and we do that by performing audit procedures. So we actually conduct testing. We collect sufficient appropriate evidence, audit evidence, for each assertion and each account. And we do that in order to obtain reasonable assurance about whether the financial report is indeed true and fair or not. So the way that we try to reduce the risk of providing an incorrect conclusion, we do that by performing as many procedures and collecting as much good quality evidence as we can on every assertion and every account to give us some reasonable level of assurance about our conclusion. So that's essentially what audit risk is. It's the risk of providing an incorrect audit opinion. We try to reduce this to the lowest level possible, and we do that by doing these things here. Now you'll notice that there's three other elements involved. We've got inherent risk, control risk, and detection risk. So let's talk about those. So there are three elements of audit risk. We've got inherent risk, control risk, and detection risk. So let's go through each one. The first one is inherent risk. Now, just for your reference, I'm not going to be reading through the slides. You can do that in your own time. But what I'd like to do in this video is to just explain how I would explain these concepts if I was speaking to you in our class. Okay? So inherent risk. What's inherent risk? Inherent risk is the risk of material misstatement. So let's just stop there. Remember, material means significant, and misstatement means information that is incorrect. Now, information can be incorrect because the number is wrong. It can be incorrect because it's describing the wrong thing or using the incorrect terminology. And it can also be incorrect because it's missing. So misstatement refers to any situation where information is wrong in some way. It can be wrong because of the number, the amount is incorrect, the wording is incorrect, or information is indeed missing. So that's a misstatement. Now, when we talk about a material misstatement, we're basically saying a significant issue. Material means significant or very important. So remember, and I have described this in a previous video, we are looking for significant issues within the financial report. It doesn't really matter if something is incorrect by $1, but we are rather looking for significant misstatements, significant issues within the financial report. So coming back to inherent risk is the risk of material misstatement that comes from the nature of the business. I'm just going to write this down for you. Nature. Essentially what this is saying is inherent risk is the risk of information being wrong or missing or inaccurate in some way, given the nature of the business and the nature of the environment in which the business operates. Let me give you an example. So think of a retailer like Coles or JB Hi-Fi. These types of businesses, they have a much higher risk of theft compared to a business like Amazon, who sells all of its goods online. So in that situation, I might just write this down for you. In that situation, Coles or JB Hi-Fi would have a much higher inherent risk when it comes to their inventory and the fact that their inventory can be stolen, right? And that would be in comparison to an organization like Amazon. So this is what I mean when I say it's the risk of material misstatement, information being wrong or missing, based off the nature of the business or stemming from the nature of the business. Organizations like Coles and JB Hi-Fi, you actually have to go into a store. In most cases, you have to go into the retail store to buy these products so you can touch them. That increases the risk of theft compared to an organization that simply sells all of its goods online. Another way to think about inherent risk is to think about organizations that engage in international transactions. Organizations that engage in international transactions have a much higher risk of material misstatement, right? Because that involves more complexity. There's different currencies, there's different exchange rates. And as a result, there's a greater risk of something being incorrect. Now, something to note here, and again, I have mentioned this in a previous video, but something or information or misstatement can happen intentionally or unintentionally. When it happens intentionally, it's called fraud. When it happens unintentionally, it's called error. Ladies and gentlemen, the intention behind a misstatement doesn't matter. If the information is wrong, it's wrong. Which means that what we look at when it comes to inherent risk is we simply look at the nature of the business, how they perform their operations, and we look at, okay, given this in nature, given this context, is there a risk of material misstatement? Is there a risk of information being wrong or incorrect or incorrectly recorded or described? So in this case, Coles and JB Hi-Fi would have a higher risk of theft compared to Amazon, which means that when we look at the inventory account, it's a much higher risk in relation to that account compared to with Amazon. Okay, so let's move on, and we'll be talking more about this in class in the weeks to come, but I just want you to start getting an understanding of these elements for now. The second component is control risk, and just like we can abbreviate inherent risk as IR, we sometimes abbreviate control risk as CR. So what's control risk? Well, before I go anywhere, what's a control? That's often a really good place to start. If you didn't know this, note this down. A control is anything that a business has in place to deal with a risk. So for example, if we go back up here, something that a business has in place to deal with theft, or Coles, something that Coles has in place, a control that Coles has in place to deal with theft, is having security guards, having security gates, having barcodes. These types of, again, controls, these types of activities or things that the business has in place are trying to deal with the risk of theft. So a control is anything a business has in place to deal with a particular risk. So for example, when it comes to securing information, electronic information, what's a control that we have? Passwords. When you log into your emails every single day, it asks you for your password. Why? It's trying to deal with the risk of someone else getting access to your personal information. So that's what we're talking about when we talk about controls. Now, businesses have many controls in place, and we'll be talking more about this in the weeks to come. Coming back to what control risk is, control risk relates to the controls and how good the controls are. Let me explain. Control risk is the risk that the internal controls within the business will not be effective in preventing or detecting material misstatements before they get to the financial report. So it's the risk that the controls will not be effective in stopping, preventing a material misstatement from happening in the first place, or detecting, identifying when a misstatement has happened and being able to fix it before it gets to the financial report. Okay, so control risk is very much focused on how good the controls are within the business. And something really important to write down is the better the controls within the business, the lower the control risk. I'll say that again. The better the controls in the business, the lower the control risk. Why? Because the better the controls, the lower the risk that they will, the better the controls, the lower the risk that they will not prevent or not detect a material misstatement. The better the controls, the more likely they are to stop an issue or identify an issue once it's happened and allow the business to correct it before it gets to the financial report. In the same regard, if you flip that over, it means that if the business has poor controls or they don't have controls at all, then control risk would be high. Because in that case, there's a higher risk of material misstatements making their way to the financial report. Now, something else to note before I go and talk about the final component of detection risk is to come back to inherent risk and control risk and tell you one very important thing. The auditor, and write this down if you can, the auditor assesses both inherent risk and control risk. Now, what does that mean? It means that we as an auditor, we cannot control or we cannot change inherent risk. Because remember, inherent risk was the risk of material misstatement coming from the nature of the business. We can't change the nature of the business. We can't change the fact that Coles has retail shops and therefore has the risk of theft. We can't change international organizations and stop them from doing international transactions. So what we do is we simply look at and we assess inherent risk. We assess the risk of material misstatement that comes from the nature of the business. In the same regard, and I'll do a little link for you, so we assess this and we assess this. We cannot change the controls within the business. We can suggest or make recommendations of good controls that the business can use, but we cannot force them and we cannot change the controls that the business has in place. So again, we get an understanding of the business and the controls they have, and we assess. Do we think these controls are good, or do we think that the controls are not good? Do we think that the controls will be effective in preventing and detecting issues? Or do we think that it will not be effective in preventing and detecting issues? So when it comes to inherent risk and control risk, we assess. We do not control, we do not change, we simply assess these risks as low, and I'll write this down here, low, medium, or high. And as I said, we'll talk more about this in class, but I want you to start getting your head around these concepts now. The final component is detection risk. Now, the reason I went back and talked to you about the fact that we assess inherent and control risk is because we don't assess detection risk. Rather, and I'll do this in a different color. Here we go. We set or we determine detection risk. Detection risk is up to us. So what is detection risk? Detection risk is the risk that our audit procedures will not detect the issues. They will not detect the material misstatements. So we set detection risk by having control over the audit procedures that we do and having control over the amount of evidence that we collect. So if we have a situation where a business has a high risk of material misstatement because of its nature, and they have very poor control, so therefore control risk is also high, we would want detection risk, the risk of our audit procedures not picking up the issue, to be as low as possible. So in that case, would we do more detailed testing or less detailed testing? We would do more detailed testing. And again, I'll put this all together for you in a couple of slides, but for now, I want you to know these three things. Inherent risk is the risk of material misstatement that comes from the nature of the business. Control risk is the risk that the internal controls within the business will not be able to stop or identify issues before they hit the financial report. Both of these we assess. We cannot change it directly, we simply assess them. The final one is detection risk. Detection risk is the risk we are willing to accept as auditors that our procedures will not pick up issues. We determine the level of detection risk we wish to accept. And again, I'll show you this in an example in the next couple of slides. So let's move on. So if you want to visualize this, it's almost like saying, okay, because of the nature of the business, again, that word nature, so does it do international transactions? Do they engage in activities that require a lot of judgment? Do they have a type of business where their assets can be easily stolen? That type of thing. Because of the nature, you've got, I'll do this over here. You've got these types of issues, okay? Potential misstatements that can happen. Now, the next level is you look at the controls, because the controls are kind of like the first barrier here, whereby they're able to stop or identify and correct some of these misstatements can be stopped here in this barrier. That's control risk. The better the controls, the more effective this barrier is, and therefore the lower the risk. The poorer the controls, the less effective this barrier is, and it allows misstatements to go through. So we've got inherent risk, which is the risk of issues happening because of the nature. You've got control risk, which is the risk that the controls will not be effective in stopping these misstatements, and therefore they flow on through. And then the third element is detection risk. This is the barrier that we use or we are set based on the procedures that we perform. Okay, so we try to stop as many issues that we can that has fallen through the cracks up here. Now let me explain all of this to you using a bit of a flow chart. Before I do that, just a reminder, remember, we cannot change inherent risk. We cannot increase or decrease this risk level. Rather, what we do is we gain an understanding of the business and we assess inherent risk as low, medium, or high. Okay, we look at the nature of the business. Remember, that's the key word here. We look at the nature of the business and we assess whether the risk of material misstatement, given its nature, is high, medium, or low. Again, we also assess control risk. We cannot directly change control risk. Now, as I said, the reason why I've added the word we cannot directly change is because, as I noted earlier, we can suggest improvements, guys. We can suggest changes. We can make recommendations on how the business can improve its controls. that at the end of the day, it's up to the business and it's up to management. So we cannot directly change control risk. Again, we simply look at the information and we assess. Do we think the controls are good? In which case control risk would be lower. Or do we think the controls are not very effective, in which case control risk would be higher. Finally, we take this information on, and as a result, we set the level of detection risk we are willing to accept. And we do that by things such as this. We set the level of detection risk based on how much planning we do, how much how much testing we perform, the supervision and revision that we, how much supervision we give and how much we review the audit work that is completed. But essentially all of this stuff is done in order to set the level of detection risk. What's the level of risk we are willing to accept that our procedures don't pick up the issue? Now again, let me put this together for you in a flowchart. All right, so to make this a bit easier, I will use similar examples to what I was using in the previous slides, just to keep it consistent. We will talk more about this in class. So let's start with inherent risk. Okay, inherent risk, so IR. Let's say, for example, we are about to audit a particular company that engages in a lot of international transactions. Okay, now when we assess inherent risk in that case, whenever there are international transactions, there's always a risk of MM, material misstatement. As a result, there's a higher risk of something going wrong in the accounting process. Remember, when there are international transactions, there's many different currencies and different exchange rates that need to be used. So because of that, it increases the complexity of the accounting and increases the inherent risk. Okay, so let's say we're dealing with a particular international organization. They engage in a lot of international transactions. So in that case, we would assess inherent risk as high. Okay. The second thing we then look at are their controls. We look at the controls of that organization and we look at how effective we think the controls are. Do we think the controls are good and therefore they're able to prevent and detect material misstatements before it's too late? Or do we think the controls are not very effective, or even is the business lacking controls? So sticking with this international organization, let's just say that their controls are quite weak. There are many areas where they don't have controls, and the controls they do have, they don't look very good. In that situation, the control risk would also be I'll do this in a different color. In that case, if the controls don't look good, they don't look very effective in dealing with issues, we would assess control risk as high. So in this situation, in this particular example of an international organization, because of the nature of the business and the nature of the international transactions, we would assess inherent risk as high, so a high risk of material misstatement from the nature of the business. And if the controls don't look very good either, we would again assess control risk as high. Remember, that means that the controls do not look like they would be effective in preventing or detecting issues in that particular organization. So if that's the case, if we're dealing with a high risk situation, we would want detection risk, which is the risk of our procedures missing something, we would want that to be as low as possible. Now at this point in time, write this down if you didn't know it, there is an inverse or an opposite relationship between inherent risk and control risk versus detection risk. So if these are high, this will be low. If these are low, this will be high. And I'll show you both cases in just a moment. So in this situation, if we're dealing with a high risk of material misstatement because of its nature and its controls, we would want detection risk, which is the risk of us missing something, to be as low as possible. Now, how do we achieve that? We achieve that by performing more detailed testing. Okay? And we do that with the hope that that will ensure that our audit risk is low. Remember, audit risk is the risk of providing an incorrect audit conclusion. By doing more detailed testing in this high risk situation, by doing that, hopefully that's reducing the risk of our final conclusion being incorrect. So that's how the audit risk model works. So in this scenario, based on this understanding, we would perform more detailed testing. So the strategy or the approach that we take in the audit will be much more detailed than in some other audits, for example. So let's flip this around. So let's say we're dealing with another organization, and I'll keep the colors the same. So we've got, once again, inherent risk, and once again, control risk, and once again, detection risk. Okay. So let's deal with another organization. Let's talk about a cupcake business, right? A cupcake business. And it's a cupcake business that only operates in Sydney. So let's just say that it's a business that is pretty straightforward, right? It doesn't really do any transactions internationally. It's only local. The processes are quite straightforward. It's quite easy to value everything in the business, and the accounting is quite straightforward as well. In that situation, when it comes to assessing inherent risk, we would assess inherent risk as low. We think that there is a low risk of material misstatement based off the nature of the business. Now, that same business, we focus on their controls. So let's say for the purposes of this example, the cupcake business has really good controls in place. They have really good controls, so by looking at them, we think that the risk of material misstatement not being picked up or not being corrected is quite low, which means that that control risk is low. Remember what I said earlier. The better the controls, I'll just write this again. Low. The better the controls, the lower the control risk. Now, in this situation, we're dealing with quite a low risk scenario, a low risk business. As a result, and remember what I said earlier about the inverse relationship between these elements and this, in this situation where it's low risk, we would be willing to take on a higher detection risk. Now, what does that mean? Well, given that it's a low risk environment, we think that there's a low risk of issues, we would be willing to perform less detailed work. So the approach that we take, less detailed testing, the approach that we take would be less detailed. Right? We would do less detailed work. We'd still do testing, we'd still collect evidence, but we would do less detailed testing. And that is linked to, and I'll do this in yellow, that would be linked to a high detection risk. Now you might be thinking, but why would I be okay with this, guys? Because it's a low risk environment, okay? The reason why we wanted to do more testing here is because it was a high risk environment. So if it's a low risk, we're happy doing less detailed work. Yes, it means this is higher, but because it's a low risk environment, we're okay with taking that on. Again, we will be talking more about this in class, but I just wanted to start to introduce you to this now. So in conclusion, it's called risk assessment. This risk assessment process that we undertake when it comes to assessing inherent risk, control risk, and then setting detection risk, the reason why it's so important is because it's through that process that we determine our audit plan or our audit strategy. What's the approach that we're going to take to the audit? Essentially, it allows us to focus more attention, more time, more resources, more energy on the accounts or the areas in the financial reports that have a greater risk of material misstatement. So in the example that I used earlier regarding a high risk of theft of inventory, if there's a higher risk that inventory can be stolen, we're going to perform more detailed testing on the inventory account, right? If there is an organization that has more international transactions when it comes to their sales, we're going to do more detailed testing of those accounts. So essentially what we're trying to do is we're trying to assess the risk in order to determine or in order to determine the strategy we would like to take, whereby we focus more attention, more effort, more resources on the areas that have a greater risk of issues. That means that we will then focus less time, less energy, less resources on auditing the areas or the accounts that are low risk of material misstatement. So we want to be effective, we want to be efficient with our time. So we're going to focus more of our attention on the areas where there are, a higher risk of material misstatement. Okay, so we'll be focusing more on this in the weeks to come, but start getting your head around this now. And so you kind of start to see the links between risk assessment and how we end up engaging in the audit. So I've included this slide in here for you. As I mentioned earlier, there is an inverse relationship between inherent risk and control risk compared to detection risk. So you can use this particular slide or use this table to help you with that. So if we have a situation where inherent risk is assessed as high and control risk is assessed as high, then that means that our level of detection risk would be low. Alternatively, if we have a situation where we assess inherent risk and control risk as low, then our detection risk would be high. So keep this in your study notes. We'll be adding to this and explaining this further in the weeks to come. Wonderful job getting through this video. I know it can be a little bit difficult to understand these concepts at times, but please make sure that you're just trying and you're starting to familiarize yourself with these new components and these new concepts, and we'll be building on this in class. Good job, and if you ever have any questions, you know you can reach out to me. Have a great day, and I'll see you in class, guys. Well done.